The weekly candle is finally closed. And looking at the terminal this morning, we are bypassing all pleasantries. It is Sunday, January 18th, 2026.
Right.
The markets are closed tomorrow for Martin Luther King Jr. Day. Normally that means a quiet, long weekend, maybe a time to unplug.
Mm-hmm.
But looking at the tape from Friday, I don't think anyone managing serious capital is unplugging.
No, definitely not. Usually a holiday Monday means, a slow drift into the weekend. This was the opposite.
The exact opposite.
We have a market that feels heavy, a bond market that is just flashing a giant red warning light, and a data calendar this week that, well, it looks like a minefield.
Yeah, it really does. We have to start with the hard numbers because the way we went out on Friday, it changes the entire complexion of the setup for Tuesday morning. We're looking at a weak rejection.
Weak is putting it politely. That was a door slam.
It was. So let's look at the close. The S&P 500 finished at 6,940, down 0.4% for the week. The NASDAQ, it took a harder hit, dropping 0.7%.
Right, but those headline percentages, they really don't tell the story.
No, you miss the actual violence of the move if you just look at that. We aren't just down slightly. We rejected a major level.
Right, the percentage hides the volatility. You have to remember the sequence of events.
Exactly. Earlier in the week, we touched fresh all-time highs. The narrative was breakout. Everyone was celebrating the 7,000 level on the S&P.
Everyone.
And then, by the closing bell Friday, we had surrendered every single one of those gains. Technically, looking at the weekly chart, we are staring at a textbook hanging man pattern.
We are.
For the listener visualizing this who doesn't spend their life on TradingView, what are we actually looking at here?
So picture a candle with a really small body at the top. That's the open and close being very near each other. And then this long shadow dangling beneath it. That's your hanging man.
Okay.
It is a classic signal of exhaustion. It tells you that buyers tried to push the price up, they tested the ceiling, they tried to hold the breakout, but they couldn't.
They failed.
They got slammed right back down. It tells you the bulls are tired, and for the first time in weeks, the bears are successfully testing the floor.
But candles can be deceiving. We always say price tells you what happened, but volume tells you who did it. Was there any weight behind this move?
That's the golden rule, and unfortunately, the answer is yes.
Total exchange volume hit 18.777 billion shares for the week. The 20-day average is only, 16.85 billion.
Right.
So significantly higher volume on a down week. That is not what you want to see if you're bullish.
We call that a distribution pivot.
Okay, break that down. Why is distribution the key word there?
Sure. So when the market goes up on low volume, or, it drifts down on low volume, it's often just noise.
Retail traders, algos?
Exactly, just chopping around. But when you see volume spike that significantly on a week where the market fails to hold a high, that is not retail selling a few shares of Apple to pay for a vacation. That is institutional offloading. That's the whales. The pension funds, sovereign wealth funds, they use the liquidity of that early week rally to sell into the strength.
So they weren't buying the dip.
No, they didn't buy the dip last week. They used the rally to get out.
So the smart money is using retail enthusiasm to exit the building. That brings us to sentiment. It feels like we're stuck in neutral, but it's a very uncomfortable neutral.
It is neutral, but it's a nervous neutral. There's a lot of friction under the surface. We've spent the last 2 years talking about the Mag 7 era.
The tech dominance.
Right, that magnificent run. Well, that engine is stalling out. We are watching a real-time great rotation.
And we see that in the divergence, right? Where's the money going if it's leaving those mega caps?
It's moving, and moving aggressively into the Russell 2000, which actually hit record highs while the NASDAQ was bleeding, and into equal weight sectors.
So if you were just looking at the headline S&P number or just watching, say, NVIDIA, you might think the market is dying, but actually the internal engine is just being swapped out.
Exactly. The generals, the NVIDIAs, the Microsofts, they're retreating, but the soldiers, the small caps, industrials, are advancing. It's actually a healthier market breadth, theoretically.
But it makes the indices vulnerable.
Very vulnerable because they are so top-heavy.
Let's zoom out and look at the macro theme. We always try to boil the market down to a single narrative driver. Right now, heading into this holiday-shortened week, what's the story?
It is policy friction versus earnings power. That's the tug-of-war.
Okay, let's take the bullish side first. Because despite the hanging man, companies are making money.
Oh, they are printing money. On the bullish side, you have pure earnings power. We got blowout guidance from the chip sector last week, specifically TSMC and Micron.
And that wasn't just good.
It was spectacular. It proves the AI trade fundamentally still has legs. The demand for the hardware is still, insatiable. If you just look at earnings, we should be at 7 to 100.
But we aren't at 7,100 because on the other side of that rope,
On the other side, you have this macro-political layer. We're seeing a growing confrontation between the executive branch and the Federal Reserve.
right?
You have politicians demanding rate cuts to juice the economy and a Fed that is trying to remain independent and fight inflation. That tension, it's injecting a political risk premium back into the dollar and, more importantly, into the bond market.
And that leads us to what might be the most fascinating data point in the entire research stack this week, the Commitment of Traders report, the COT report.
I love this report.
I know you do. But for the listener who doesn't read the COT with their Sunday coffee, this basically tracks how the big players are betting. And right now we are seeing a massive divergence.
It is huge. I mean, I haven't seen a split this wide since early 2024. This is the pain trade dynamic in a nutshell.
So walk us through the players. Who's betting on what?
Right. So first, you have the asset managers. These are your long-term funds, your pensions, mutual funds, the real money. They are currently net long 379,000 contracts.
That's a massive bullish position. So they're betting on the soft landing. They're betting on the Fed pivot. They are all in.
Correct. They are positioned for the 2026 rate cut cycle. They think everything's going to be fine. But you look at the dealers and market makers,
The banks, the guys who facilitate all these trades.
the smart money, these are the guys hedging their books. They are holding an extreme net short position of 459,000 contracts.
Wait, pause there. That is a massive discrepancy. You have the long-term money betting huge on the upside and the smart money betting huge on the downside.
Almost 500,000 contracts short.
Why are the dealers so short? What are they seeing?
It's an asymmetric risk profile. The dealers are hedging against a macro shock. They're looking at the political risk, the inflation data, and they are buying insurance.
Okay.
But here's the catch, and this is why we call it the pain trade. If the market doesn't break down, if we just tread water or tick slightly higher, those dealers are going to be so underwater.
Because they're short.
Exactly, and they will be forced to buy back those shorts to cover their exposure.
Which creates a squeeze.
A massive squeeze. It's often called a gamma squeeze. When dealers are short gamma and the price moves against them, they have to buy into the rally, which pushes the price higher, which forces them to buy even more.
So the pain trade right now is actually to the upside. The market is technically shorted by the mechanics, even if it feels expensive fundamentally.
Precisely. If we don't get bad news this week, that short covering alone fuels a rally. The springboard is loaded.
Before we get into the crazy calendar for this week, and it is a minefield, we need to define the technical lines in the sand. If I'm looking at my charts Tuesday morning when the bell rings, what numbers matter?
For the S&P 500, the level to watch is 6,885.
Why that number specifically?
That was last week's low. It's the pivot. As long as we are above that, we're just consolidating, we're chopping.
Well, if we close below it,
If we get a daily close below 6,885, we expose the 50-week simple moving average down at 6,835. And that changes the conversation from healthy consolidation to correction.
and for the NASDAQ, you mentioned tech is the real weight right now.
Oh, tech is in trouble. The NASDAQ 100 failed to hold its breakout. It is currently trading below a falling trendline support near 25,529. The absolute floor, the panic button is the 50-day SMA at 25,325.
And if we lose that?
The trapdoor opens to 25,000. That's where the algorithms will start selling automatically. That is where those asset managers we just talked about, that's where they start to panic and liquidate.
But the real story, the one that really dictates everything else, is the bond market. The 10-year Treasury yield closed the week at 4.23%.
And that is a breakout pending. We have been talking about this 4.20% cap for months, and now we are officially above it.
I want to spend a second here because we mention yields all the time, but why is 4.2% the magic number? Why does an algorithm care if it's 4.19% or 4.21%?
Well, it's psychological and it's mathematical. 4.20% was the ceiling for the last 3 months. So breaking it signals that the market believes inflation is sticky.
Okay.
But mathematically, it's all about the discount rate. When you value a stock like NVIDIA, you're valuing earnings that will happen 5, 10 years from now. You have to discount those earnings back to today's dollars.
And the yield is the discount rate.
Right. The higher the yield, the less those future dollars are worth today. So when yields break out above 4.20%, the math just juster. It stops working for high multiple tech stocks. Valuation compression kicks in. If yields go up, tech has to come down to adjust.
Okay, let's look at the calendar. We established Monday is a holiday in the U.S. Markets are dark. But you've labeled this week a macro minefield.
It is. Just because New York is closed on Monday doesn't mean the world stops. Global risk is still trading, and it starts immediately on Monday with China.
Right, Monday, January 19th, we get China's Q4 GDP and their activity data. Now, usually, U.S. investors might ignore this or check it casually. Why does it matter so much this week?
Context is key here. Since the U.S. is a ghost town on Monday, all global volume, all the liquidity in the entire system is going to center on Beijing, and we're looking for that growth number.
Give us the scenarios. What are we rooting for?
Well, it really depends on your book. Scenario A, it comes in hot, say, above 4.6%. That means the Chinese stimulus is working, the reflation trade is back on.
And you would see.
You'll see a rally in copper, iron ore, the Aussie dollar.
Okay, and scenario B.
It comes in cold, let's say below 4.4%. We get a global growth scare, and that triggers a safety play right into the U.S. dollar and treasuries. Emerging markets will get crushed.
So even if you aren't trading the Hang Seng Index, if you're holding stocks like Rio Tinto, Vale, or even Caterpillar,
you are exposed. Those are the specific proxies. If China sneezes on Monday while we are grilling burgers or watching the game, Caterpillar catches a cold on Tuesday morning in New York, the gap down could be severe.
then we have a bit of a lull until Thursday, January 22nd. And then we get what the research calls the data mega dump.
This is the #1 event of the week. And you have to remember the context. We just came out of that government shutdown scare, so the agencies are behind on their reporting.
Right.
On Thursday, the Bureau of Economic Analysis is releasing the October and November revisions simultaneously alongside the Q3 GDP updates.
So a double dose of data. That sounds messy.
It's a flood.
Yeah.
And embedded in there is the PCE, the Personal Consumption Expenditures Index.
And just to refresh everyone, why do we care about PCE more than CPI? We just got CPI recently.
Because the Fed cares. This is their preferred inflation metric. It tracks what people are actually buying, not just a static basket of goods.
So beef is expensive, you buy chicken.
PCE captures that. This is the ultimate test for the pivot.
Walk us through the reaction function. What happens?
If that core PCE comes in hot, anything above 2.8%, the higher for longer narrative returns with a vengeance, we will see 10-year yields breach 4.5%. Stocks will dump because the market will price out the March rate cut immediately.
And the flip side?
The Goldilocks scenario. If core PCE is below 2.5%, equities rip. The narrative holds that the Fed has threaded the needle.
And the specific exposure there is obviously technology.
It's binary, rates up, tech down. There's really no middle ground on Thursday.
That takes us to Friday, January 23rd, the Bank of Japan rate decision. Governor Ueda is on the stage. I know some listeners' eyes glaze over when we talk about the Bank of Japan, but you mark this as a sleeper risk.
This is arguably the biggest risk to U.S. liquidity. Ueda is under massive pressure to defend the yen. The currency has been incredibly weak.
But why does a rate decision in Tokyo matter to a trader in Chicago holding Apple or Nvidia?
It comes down to one thing. The yen carry trade. This has been the engine of global liquidity for 2 years.
We hear that term carry trade thrown around a lot.
Yeah.
I want to make sure we nail the mechanics here. How does it actually work?
It's simple arbitrage, really. Interest rates in Japan have been effectively zero. So massive hedge funds borrow billions of dollars worth of yen for free. They take that yen, they convert it into dollars, and then they buy U.S. tech stocks or U.S. treasuries that yield 4 or 5%.
So they're borrowing in a cheap currency to buy a high-return asset. It's free leverage.
Exactly. It's free money. But here's the danger. If the Bank of Japan gives a hawkish signal on Friday, if they hike rates or signal an exit from yield curve control, the cost of that borrowing goes up.
And the yen strengthens.
And more importantly, the yen strengthens against the dollar. If the yen gets stronger, paying back that loan gets a lot more expensive.
Right.
If the yen jumps 2 or 3%, it wipes out the entire profit from the interest rate spread. So the trade unwinds. And when it unwinds, it causes a violent repatriation of capital back to Japan.
So they have to sell.
They have to sell the U.S. assets, sell the Nvidia, sell the treasuries to buy yen to pay back the loans.
And that acts as a massive liquidity drain for the S&P 500.
Correct. A hawkish BOJ is basically a margin call for the global financial system. So if you are heavy in global banks or high beta tech, you are watching Governor Ueda very, very closely on Friday morning.
So just to recap the minefield, we have a closed market Monday, China data while we sleep, a data megadump Thursday, and a potential liquidity shock on Friday from Japan.
A classic quiet week.
Right. So let's talk about the game plan. How do we execute the trades starting Tuesday morning?
The strategy right now, I think, is clear. Don't buy the index, buy the rotation.
Break that down.
If you just buy SPY, the S&P 500 ETF, you are buying a stalling engine. It's weighted toward those tired tech stocks. You're buying the hanging man.
Okay.
But if you look under the hood, energy and materials are outperforming tech by a ratio of 6-to-1 year to date. That is where the momentum is.
So we're looking at the China proxy sectors and the inflation hedge sectors.
Exactly. If you believe the China reflation story from Monday's data, you buy the minor stocks like Freeport-McMoran. If you're worried about the data megadump showing inflation on Thursday, you buy energy. You want to be where the puck is going, not where it was in 2025.
And watch that danger zone on the yields.
The 10-year yield is your dashboard warning light. If it stays above 4.2 RNs%, that tech-to-value rotation isn't just a blip, it accelerates. You want to be on the receiving end of that capital flow, not the departing end.
And for the S&P 500 specifically, we're watching that 6,885 level.
That is the line. As long as we hold 6,885, we're neutral. If we lose it, we are bearish. It is that simple.
It's interesting because despite the hanging man candle, despite the volume distribution, all the exhaustion, that positioning data from the COT suggests there's still fuel in the tank if we can just avoid a disaster.
That's the final provocative thought here. We have a paradox. The market is fundamentally expensive, valuations are high, but technically it is heavily shorted by the dealers.
So the springboard is loaded.
The springboard is loaded. A rally this week doesn't need good news. We don't need a miracle number from the GDP. We just need the absence of bad news. If the world doesn't end on Thursday, those dealers have to cover nearly 500,000 contracts. Yeah. That is powerful buying pressure.
It's going to be a fascinating week to watch the tape. Enjoy the holiday. Keep an eye on China and stay sharp. We'll see you at the opening bell.